Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I utilize my portfolio in order to make weekly income. For today's video, I'm going to be showing you some option strategies if you're trading with a small account. So, welcome to Investment Gains. Let's jump right into it. Welcome back, investors, and for those of you visiting for the first time, welcome, future investors. Now, it's extremely hard to grow a small account if you don't have the right option strategies. So for today's video, like I said, I will be giving you some option strategies that can be used if you're trading with a small account. So as you guys know, on this channel, we like to get down and dirty with options because that is the only way to learn options trading. So for today's video, we're going to get started with the Invesco QQQ Triple Q. Okay, so here we are on the Invesco QQQ, and in order to get this option trade going, let's go ahead and click Trade QQQ Options to your bottom right in order for us to open up the option chain. So now that the option chain is open, in order to get this first strategy going, we're going to go ahead, we're going to select Sell, and then we're going to select Put, and we're going to go ahead and choose our strike date. We're going to be using the strike date of August 30th. Okay, so one thing to keep in mind is that the QQQ is an ETF, and this ETF has daily expiration dates. So this allows you to trade even more. But be careful. If you are trading with a small account, always be aware of the PDT rules. Okay, so now we are on sell and put, and we have chosen our strike date. Now we're going to go ahead and we're going to choose our strike price. Now, for this strategy to be the most effective, it's highly advisable to choose the strike price below the share price. So as you can see, QQQ is trading about $480 per share. So we're going to go ahead and we're going to select our strike price. And I will be going with let's go with the 470 strike price. As you can see up here, it says strike price. We're going to go ahead, we're going to click into this. And right away, once I do this strategy, I will be receiving $1.98. In option terminology, this is going to be equal to $198. And that's because each option contract is multiplied by 100 shares. Now, this option strategy is just one leg of this two-leg option strategy in which I'm going to show you. But this first leg is known as the cash secured put. Now, I'm pretty sure the question you're asking is why did I go ahead and choose the 470 strike price? Well, based on 5 years of trading, I have developed my own personal risk tolerance. And me personally, whenever I'm doing this option strategy, I look for a chance of profitability of 80% or higher. So any strike price that's going to be 470 or below will fit into my criteria. So that being said, this first strategy, once again, is the cash secured put. Now, if you're trading with a small account, there's no way you will be able to afford a cash secured put. Let me show you why. Let's go ahead to continue. We're going to choose one contract and we're going to hit review once again. So in order to do this option strategy, you will have to come out of pocket of $47,000. And if you trade in and you do have $47,000, you do not have a small account. Okay, keeping in mind that we don't have $47,000, now I'm going to go ahead and show you how to make a slight tweak to this option strategy in order for you to trade the same option strategy but use a lot less of your capital. So let's go ahead once again, and now we're going to go to buy and put, and we're going to maintain the exact same strike date. Now for this one, we're going to be choosing our strike price just below our previous sell call. Remember the cash secured put, we sold a put. Now we're going to be buying a put. And we're going to be choosing our strike price below the sell put, and let's go with the 468 strike price. Let's go ahead and click into that. Now, previously, we sold the put, so we receive $1.98. Now we're going to be buying a put. Now we have to pay $1.63. The difference between the two is what's going to be your credit. So as you can see here, you're going to be receiving $37.94, or let's round it up to $38. And this strategy is known as the put credit spread. Now, the put credit spread is an income generating option strategy, meaning whenever you do this strategy, you receive money right away. And this is going to help you grow your small portfolio. Now, here's the kicker. It does not matter how this trade goes. That credit you receive is going to be yours to keep no matter what. And that's what helps grow your portfolio. Now, there are a few more caveats to this trade, so we're going to go over that as well. With every trade, there are risk and reward. But right before we do that, if you guys are getting any value from this video right now, feel free to hit like and subscribe to the channel to become part of the weekly income team. And if you guys need help with options, go ahead and click any of the links below. We do have one-on-one coaching and we do have a free options ebook. Okay, so let's go ahead. So come expiration on August 30th, how can this trade go? Well, this trade could go in a couple of ways. The first way it can go, if at expiration the share price is higher than 470, then the trade closes out. You get to keep your $38. You get your collateral relief back to you, which is going to be $200. And then you get to do this trade again for the following week. So let's just determine the collateral. Well, the collateral of $200 is determined via your spread. So your spread is going to be your difference between your strike prices. So the difference between 470 and 468 is going to be $2. You multiply your $2 by 100 and you get $200. Now, the other way this trade could go, come expiration date of August 30th, once again, if QQQ is trading at a share price of below 468, then once again, you get to keep your $38, but this time you're going to lose your collateral of $200. So your loss is not going to be a total of $200. Your loss now is going to be your $200 minus the $38 which you received initially. So it's not all lost. Now, the way you grow your portfolio with this particular strategy is to maintain a high win rate. Now, like I showed you before, I like to choose a chance of profitability of 80%. That means if you were to do this trade, you should be winning 4 out of 5 trades. Now, there's a third way in which this strategy could go, which no one ever mentions. Come expiration date once again of August 30th, if the share price of QQQ is anywhere between 470 and 468, then once again, you get to keep your $38, but this time you get part of your collateral back. And that is one income generating option strategy that can be used if you're trading with a small account. So let's go ahead and get into a second strategy that can be used if you're trading with a small account. So for that, we're going to go into a different stock and let's go and use Xpeng, ticker XPEV. Okay, so here we are on Xpeng, ticker XPEV. Now, the reason why I chose this stock is because it's trading for $7 per share. So if you were to buy 100 shares of Xpeng, it would cost you less than $1,000. So this is a good stock to trade if you're trading with a small portfolio. So let's go ahead now to trade XPEV options in order to open up the options chain. Now, if you're trading with a small account, you would want to get the stock at the best price possible. So for this option strategy, we're going to go ahead now and we're going to go to sell. And now we're going to select put as well. And we're going to maintain our strike date of August 30th. So now we're going to go ahead and we're going to choose our strike price below the current share price. And we will be going with the $7 strike price. Now, with the $7 strike price, that gives me only a 64% chance of profitability. And I'll show you why it doesn't really matter with this option strategy. And with the $7 strike price, I also will be paid 0.23 or $23. Now, this, as you can see here, is similar to the first option strategy, except for now you're going to be doing it with a stock that you can afford in your portfolio. And that strategy is none other than the cash secured put. Now, in order for you to get going with a cash secured put, you must have the cash equivalent in your portfolio in order for you to accumulate 100 shares of the stock. So in this case, I must have $7.03 multiplied by 100 shares, which is going to work out to be $703 in order for me to do this trade. So let's go ahead and click continue. We're going to go ahead and choose one contract and we're going to hit review. So if I were to do this option strategy, I will be receiving $23 into my buying power. Now, this money, again, is mine to keep no matter how this trade goes. Anytime you're doing income generating strategies, it helps grow your portfolio. Now, in order for me to do the cash secured put, I will have to leave a collateral like I mentioned earlier, and that collateral is going to be $700. how did they determine $700? Well, the $700 is going to be determined by the strike price I chose, which is $7, and you multiply that by 100, and that's going to give us the 700. So, what is this strategy actually saying? This strategy is actually saying from August 30th, if the share price of XPEV is trading at $7 or below, I agree to buy 100 shares. So the number one caveat, if you're going to use the cash secured put, is always trade with a stock you don't mind owning in your portfolio. That way, if you are forced to buy 100 shares, it is a stock that you actually want in your portfolio. So, how can this strategy work out from expiration? Well, at expiration date of August 30th, if XPEV is trading at any price above $7, then you get to keep your $23. And then now you get your $700 released back to you. And now you could go ahead and do the strategy for the following week. So the other way this strategy could go is that come expiration date of August 30th, once again, if XPEV is trading at any price below $7, then once again, you keep your $23, but now you're forced to buy 100 shares. This option strategy is what I call a win-win option strategy. The reason I say this is a win-win strategy is because if you do get assigned and you're now forced to buy 100 shares of the stock, well, now you own 100 shares of a stock that you wanted to own in the first place, but now you got it at a reduced price. So now you have the 100 shares of the stock. What do you do? So now you could go ahead and swing around and go to a different strategy, which is going to be called the covered call strategy. But we're not going to get into that. We're going to go to part 2 of this video. I'm going to show you some additional option strategies if you're trading with a small account. So investors and future investors, those are two option strategies can be used if you're trading with a small account. Now, I would like to thank you guys for watching, and remember, hit the like button and also subscribe to the channel in order to become part of the weekly income team. And if you guys need any help with options, feel free to check out the links in the description below. And until the next video, remember, keep pushing your investments. But right before you go, two videos going to be appearing right now. Feel free to click on any one of them. They're both going to be able to help you to continue being part of the weekly income team. Keep pushing your investments.